Well, Happy New Year, everybody, and welcome to our kickoff webinar for 2020. Special shout out to Sally's family in England who are joining us on this event. Right? So, okay, so Julia, if we go to the next slide then, please. So the first question that really everybody should ask themselves, and we ask developers when they come to us, and we call this the big question. And the big question is this: are you building this proposed apartment building for yourself to keep for the long term, for 20, 30 years, or for the grandchildren, or are you building this to sell? And it's important that you answer that question as best and as deeply as you can for you to make the right decision. So for example, where you build is determined by whether you build long-term or short-term. So let's say you want to build an apartment in a smaller town. Well, you know what? We generally have found that people get higher yields in smaller towns. But if you build in a smaller town, maybe get a 7% development yield, which would be terrific, right? But that's the problem with building in a smaller town: liquidity, right? So everything has to be balanced. So if you're a merchant apartment builder, then you want to be building in a city where you can have lots of liquidity because you need to sell. But if you're building this to keep it forever and you're never selling it, then you're less concerned about location. Like, that's an example of the kind of thing that we need to answer, okay? So also the number of units, right? If you build a very small building, then it's got high liquidity because there are a lot of buyers. If you build a large building, over $100 million, then you're going to have to worry about your buyer pool. But over $100 million, there's not more than 10 or 15 buyers, in the country and things like that. So how much parking you put in determines. If you're a long-term keeper, you absolutely have to get the parking right because you're going to live with that problem forever. But if you go a little skinny on your parking, you happen to get your building full and it's a strong market, then you can probably get away with a little less parking. Not a good idea, I'm saying, but that's the way that you think, right? So that's what we think that's what we call the big question, right?
So what about the size of units as well, Derek?
Well, okay, so if you're a merchant apartment builder and you build, let's say you're building in a suburban location, right? And you think that your target market is going to be affluent seniors selling their homes, right? Well, then you want to naturally build large apartments, right? But if you build large apartments, it's going to take longer to fill up. So if you're a merchant apartment builder ready to exit quickly, that may be a problem. You got expensive mezzanine money and things like that. And then when you go to sell the building, your price per unit is also not quite high because the unit's so large.
Right.
So now you're the acquisition manager sitting at a pension fund saying, do I want to be paying, X amount of dollars, at this on a price per unit basis? Although I don't think that's necessarily the right metric. The right metric might be price per square foot, right? Anyway, just to kind of recap, the big question that you have to ask yourself, and that we're going to ask you over and over again as we go through our relationship, is: are you building this apartment to keep, or are you building it to sell? You may not necessarily know the answer, but which one are you leaning towards doing? Because we're going to design the building with you a little bit different, right? Okay, all right. So next slide. So in terms of the pipeline, and this is Sally's department. Sally runs our research division. She's got a group of about 10 people. But the number one question that we always get asked is there demand? Well, the answer is there is demand. We're going to answer it for you now a little bit more specifically. But your problem in almost every market, except I'd say maybe Fort McMurray, right, or any place that's very resource-based, that's going through a downturn, the demand is there. So Sally, let's walk through a couple of slides in terms of just showing people how much construction there is, but more importantly, how much can get absorbed and the metrics that we use.
Absolutely. So, I mean, the key component of our research department is we do feasibility studies. But key to feasibility studies, when we're asking should you build, is understanding what each market can absorb. And to understand that, we need to track development applications. We need to understand what is potentially coming up in the marketplace, so that you have confidence that when your building comes to market in, let's say, 2-3 years, at a good case, best case scenario, you understand all the other developments that are going to be coming on stream at the same time. So one of the initiatives that my department does, we track all development applications across the country. It's a mammoth task, and obviously it's something that we have to update on a regular basis. At the moment, we update it every 3 months online. So we call it the Apartment Crane Watch. You can go to our website. I put the website at the bottom. So a lot of the data that I'm going to be talking about today in terms of the pipeline comes directly from this exercise that we do. Next slide, please, Julia. So this is just what the tool looks like on our website at the moment. So we currently have the GTA, we have Ottawa, Kitchener-Waterloo, Edmonton, Calgary, and Halifax. And I'll talk about some of the other markets we're adding to it. We collect the data, we just haven't put it all up yet. So we look at, these are purpose-built rental buildings, and we look at what's in pre-construction, under construction, and recently.
Right, so each dot represents a potential site. Okay, good.
Exactly. So next slide, please, Julia. So in terms of what we're working on in terms of adding to it is Vancouver, Winnipeg, and Montreal. Next slide. Okay, so before we get to what's coming up in 2020, obviously CMHC recently, or yesterday, updated their stats for 2019. So I thought it was useful just to look at where we've come in the last year before we look at what's in 2020. So this is for all of Canada. So you can see that about 25,000 new units entered the market last year, which is down about a third from 2018, but it's still strong growth. And I know that when I showed this to Derek, he said, "Sally, that's nothing."
Yeah, Sally, every year in Dallas, in the Dallas-Fort Worth Metroplex, they build 20 or 30,000 apartments.
Right.
All of Canada doesn't build that, right? So again, if you're listening here and people are saying, well, is the market there to absorb the markets, right? One city in the USA, right? Albeit growing, bustling, city, builds that many apartments that the rest of Canada builds. So it's important that people understand that the depth of the market is there. Okay, let's keep going.
Sure. So in terms of where construction has happened, obviously the largest provinces see the most new growth. Quebec has a history of a culture of renting, unlike anywhere else in Canada. So obviously there were more new rental apartment units there. But you can see, Ontario, BC, Alberta remain strong. What's always surprising to me is how much development is occurring in Nova Scotia, specifically Halifax, but we'll get to that in a second. Yeah,
and so when you just look at this, you see Alberta and Nova Scotia are almost about the same levels.
Yeah.
If you add up, you look at British Columbia and Alberta are, combined are smaller than Ontario.
Yes.
Yeah, when you add up the amount of development there versus our population, right? So there can be a lot more development of apartments in Ontario. There can be a lot more apartment development across Canada.
Yeah.
But I think in Ontario it's particularly acute.
Exactly. Next slide, please, Julie. Okay, so what I was interested in is looking at, so which markets saw more growth and more development in 2019 compared to 2018. So really, this is an East Coast story. There's been a lot of developments out there. So PEI, Nova Scotia, New Brunswick all saw more new development last year than in 2018. I'll talk about their pipelines in a second. And BC obviously was surprising to me as well. Significant growth, over a third more than last year. And in Northwest Territories, obviously there's not that much development going on there. So any new development is going to tip the needle on that one. So what's coming for 2020? So this comes directly from the planning applications that we track. So in Toronto at the moment, coming into 2020 as we roll on to the new year, there is approximately 3,000 new rental apartments under construction. Obviously, not all of those are going to hit the ground in 2020 because some of these are very large projects that will take a couple of years to complete construction. But you can see that last year there were about 2,000. So we're looking for the boom to continue within Toronto for new apartment construction.
Yeah, and let's just put this in perspective, right? Toronto gains something like 100 to 150,000 people every year.
Correct.
And it's been doing that for the last 20 years, and hardly any apartments have been built. So you're not building for future demand if you're a developer in Toronto.
Right.
In Dallas, you're building for future demand. You're looking at what growth projections are. In Toronto, you're building for an extreme pent-up demand where we have an acute, rental housing shortage, and it only gets solved by building more purpose-built rental apartments, not by building condo rentals.
Right.
Another story, but okay.
Yeah.
Halifax?
Okay, so Halifax this is a market we've done a lot of work in the last year and a half, 2 years, just because there have been so many new units enter the market. So in 2019, there are approximately 1,800 new markets. You compare that to Toronto, it's almost as many as hit the Toronto market, and they're very different in terms of scale of population. So we've done a lot of work there because developers are wondering, how long can this boom continue? If you look at what's moving through the pipeline at the moment, through the approvals process, there are 4,100 units planned for approval.
Right. So Sally, when we compare that to Toronto, that's almost astronomical, right? The
Absolutely.
Halifax, Dartmouth Metroplex is
Yes.
400,000 people. Toronto's 5 million people.
Yes.
So it's 10 times the size already, and we're already 25% less than Halifax. So
Right.
It's an order of magnitude difference. And Halifax isn't building too many apartments. I think Toronto is building too few apartments,
Yeah.
right? And that's really the story across the country.
Exactly, and what we've been doing also is tracking lease-ups. And so if we saw a problem with lease-up, then we would obviously indicate that here. Okay, Edmonton, about 900 new units entered the market last year, and there's about 2,000 currently under construction. Really strong market. We've done a lot of work there too. Ottawa, there's approximately 1,500 units under construction that will hit the market in 2020. Which is a little bit higher than what entered the market in 2019. Okay, so how many apartments can each market?
Right. So this is something that you can't really just put your finger on, right? It's not like you're saying you can actually identify the rent easier. Like there's a competitor building across the road, you can be a little bit better, your rent will be a little bit higher. But how many apartments can each market absorb? I think that we're saying that overall we have had a deficiency in apartments built in Canada for the last 40 years. So you're building to cut for demand that's already there. Okay. But the way to look at this is first, let's just look at a stat. Let's go to the next slide, right? And let's look at the number of apartments per 100 people. It's a pretty simple calculation. I'm going to just walk through it here, right? So you take the cities there, and then you take the rental universe. That comes from CMHC. So that's how many purpose-built rental apartments are 6 units or more. So Montreal has 591,000, right? And then that same Montreal metro area has 4 million people. So if you divide one by the other, you get a density of 14.4 apartments per 100 people. That's of a major city. That's the highest density that we have in Canada, right? Now, and then as you go down, you see Halifax is 12.7. Toronto is 9.8. Now, none of these markets have excess apartments. Nobody's got significant vacancy rate. If there is a significant vacancy rate, it's localized because of a local thing in the economy going on right now, right? So as you go down that list, you can see that if Montreal's at 14 and not in an oversupply scenario, and Halifax at 12 and not an oversupply scenario, then look at all these other cities, right? 9, 8, 6, 7, so on. So the first point we're making is just as a rough cut at does the market need apartments, just do that simple calculation for the city you're in, and you're going to find that number is going to be actually, probably quite low. Now let's look at some kind of outlier cities that aren't included in the table. London, Ontario. Now London is one of the few cities in Canada blessed with, and I say blessed with, some very talented developers who are programmatic developers. They've been building for a long time and they build regularly. London has 10 apartments per 100 people. I think if you talk to the average apartment guy or guru on the street, he would say, well, London has too many apartments. Well, maybe the way to view it is the rest of the country has too few apartments. Because the London market is very strong right now. Vacancies are low and rents are rising. So 10 apartments per 100 people for a mid-sized Canadian city seems like a very reasonable benchmark, and the majority of cities in Canada are well below 10 apartments per 100 people. Now, take Burlington, Ontario. Burlington is the city that Sally and I are in right now. It's where we work and live, and Burlington has 5.5 apartments per 100 people. Again, not a staggering number. Oakville, which is almost like a sister city, right beside us, by the way, the most affluent city in Canada, has 2.7 apartments per 100 people. Now, are the people in Oakville that different from London, that it's got 4 times less apartments? No. There's an opportunity here to build apartments across Canada in various markets. Okay. So Sally, let's talk about vacancies. That's something people are about. Well, vacancies could be high if we build too many apartments.
Yeah. So this is new data from CMHC. So really, what I sorted it by was how vacancies have changed between 2018 2019. But what Derek wanted to point out is if you actually just take 2019, which is what I put the red box around, there really isn't any city with a huge vacancy problem. The outliers, I guess, would be Calgary, St. John's, and to some extent Edmonton.
Yeah, and that's related to the energy sector, right?
Correct.
Right. Those markets were super tight when oil prices were high, right? There was a chronic shortage of apartments. Right?
Yeah, but across the board, we've seen a tightening of vacancy rates in the last year in most markets, and where vacancy rates have increased, it hasn't been significant.
Right, and there hasn't been massive rental drops either in those cities where the vacancy rate has gone up. By the way, in most U.S. cities, when the vacancy rate hits 5%, developers start building. Yeah, right. Exactly. All our vacancies are
except for St. John's, but
except for St. John's, but every single one is below 5%. Right. So I guess the message, and we're kind of saying it, in different ways, is that there is room to build in this market, and our markets are a long way from being overbuilt.
And we don't see that changing in 2020.
We really don't, and I think we don't see that changing for the foreseeable future. Now, keep in mind, when you're building purpose-built rental apartments, you're building for the discretionary renter at the top of the market, right? So they're not necessarily coming out of another apartment. In fact, often they're not coming out of another apartment. They're coming out of a rental condo. There's someone new to the city who's affluent, or there's someone who's, and most of the houses certainly in our area have doubled in the last 5 years. People are twice as wealthy as they were. When they sell their house, they've got more money to rent, and they might downsize from a 2,500 or 3,000 square foot house, but they're not going into 750 square foot 2-bedroom, 2-bath condo unit. They need a proper size unit, so they'll go down in size, but they won't go down in quality. So we provide services to developers, and it's a complex set of services, right? It goes right from the initial, I've got this idea, I want to build apartments, right through to the sale of the apartment. So what we've done is we produced a Super Bowl commercial, okay? And it's less than 3 minutes. And actually, we're going to show it to you right now. And we'd love your feedback on it. It's the first time we've ever shown it to anybody. And we're hoping that it'll give you a good sense as to what we do without us waxing on too much about it. Okay.
And then we'll be right back with some more information.
Right. So here is the world premiere. We are the one-stop shop for apartment developers. You're missing a certain set of skills. We have those skills.
Derek always follows his clients very closely. It's not just the broker that will come and disappear once a deal is done. It's an ongoing relationship.
So developers typically come to us with an idea as to a specific site they want to develop or a specific market they want to penetrate for purpose-built rental. The first thing we would do is conduct a feasibility study to let them understand as to whether they should be developing either on that specific site or in that market.
Then we help the developer and his team design the ideal building to go on that site to maximize profitability.
The next stage is financial modeling of the project. We have developed a comprehensive financial model.
And we'll either give you our financial model or train your people to adjust their financial model so it takes into account the nuances for apartment development, leasing, and stabilization.
Next is our marketing, which begins with a shred. The shred is a series of meetings with you and your team.
Your development guys, your construction guys, your property manager, your architect, your landscape designer, your interior designer. We're working with these third parties to get everyone's knowledge onto the table, designing the best building we can based on the research that we've already done.
We then go on to create and execute the detailed marketing plan that covers everything from branding to your website to your digital advertising and even social media.
But our marketing process works hand in hand with our leasing process. So we execute the marketing plan when the hoarding first goes up. And then through the process of construction, closer to the end of construction, we're going to hire and train the leasing team that's going to go into your property and rent those apartments for you. And that's really where all the money gets made.
Derek and his crew are extremely bright, helpful, very quick, and I highly recommend them to anyone who is considering or heading in that direction.
The last stage in the end-to-end process is to sell your building, and who better off to sell your building than the company that's been working with you from the beginning and knows your building inside and out. SVN has sold 25% of the most expensive new apartment construction deals in Canada.
The consulting business has been great, and the sale, the brokerage has been fantastic too.
We are the 6th largest brokerage firm in Canada in terms of transaction volume, but we're number 1 in deal size. Our average apartment deal is $10 million more than our nearest competitor. We've been in this business of developing apartments and leasing apartments for over 30 years. And we've really had the good fortune and the privilege of working with just some extraordinary developers. Well, we Well, we appreciate you just taking a few minutes to watch our little documentary here, and if you think it's appropriate, send us a little feedback on it. We have 20 people who work in our firm that help us get to sort of this from point A. You have this vision to build an apartment to point B, which is usually 2, 3, 4, 5 years later, where you've decided to sell the building. Many of our clients decide to keep the building, as well. Okay, so let's go into the sort of the brokerage side of the building in terms of what's my how many new apartment buildings have been built, right? And then let's talk about what the price of those buildings are as well,
and
right?
Where we see it going next this year.
Right. Okay, good. All right. Okay. So these are the apartment buildings that have been built since 1991. Right. So we've tracked all the apartments built since 1991 and built and sold. Built and sold. Yep. And so you can see that, in Ontario, 93 buildings have been sold, in British Columbia, 85, in Alberta, 68, and then you go down. But again, look at, if you add up BC and Alberta, right, they're almost double of what Ontario would be, right? So there's been a lot more buildings built out there, and as well as there have been more transactions, right? All right. Now, the next slide shows you the number of buildings sold every year. Again, what we're seeing is in every category we're going to show you, there's an upward trend as you draw the line through here. So when you look at the number of transactions, you go back to 1991, there were 5 transactions, right? In 1991, and then that number is just growing up, right? So we're looking at 30, 40, 50, 60 transactions per year as time goes on, right? So the next slide shows it by city.
Yep. So this is where transactions occurred last year. The top 10 cities that saw transactions. So Edmonton was the city that saw the most new apartment transactions, followed by Vancouver, then Montreal, then Toronto. And really it feeds into where the buildings are being built in the first place.
Yeah, it does. I would say there's one interesting difference between Toronto and Vancouver. So I think when you look at Vancouver, it's not, and compared to Toronto, you shouldn't necessarily look at the number of buildings as opposed to the number of units. Mm-hmm. So in Vancouver, they're building smaller buildings, right? And Sally and I have driven around Vancouver lots. We're going to be there again in April. And you see there, 100-unit builds with retail on the ground floor. Right in Toronto, you see 200, 300, 400, 500-unit buildings being built. So the number of buildings built as well as the size. Okay. Now, in terms of apartment transactions, you can see here the average price that's being paid for the entire property, not on a price per unit basis, but so back in 91, first of all, there were way fewer transactions, and the average size was around $10 million, right? And you can see that's steadily growing. Yep. So it's implying two things: the price per unit is going up, but also the size of the buildings is going up, the size of the projects, and there are more and more buyers entering this space. And I would argue that it's a chicken and an egg thing. If you build it, they will come. The renters will. But if you build it, the buyers will come. But buyers won't. So, for example, the Canada Pension Plan, right? I think they would love to start investing in brand new purpose-built rental towers in major Canadian cities. Yep. But it's hard for them to enter the space with so few coming on and so many transacting. So if there were more built, there'd be more money coming. Yes. Right? But there's not more money coming because there's not being built, and it becomes a little bit of a circle here. Right? Okay, good. So the next slide is the price per unit. Price per unit, irrespective of the building size. Correct. Right? So again, here you see that when we first started off, prices were $150,000 per unit, and now they're rising up to $350,000 per unit. Now we just worked on the I think it was the largest transaction in Canada that closed last year, where the average price per unit was over $570,000 per unit. Right? That's a big jump, and I think that we're not far away from seeing the $1 million price per unit. Right? Now, price per unit that's an easy number for a broker to use, but it's not the right metric. Right? So if you bought all bachelor apartments and you paid $400,000 per unit, well, that's a very expensive building. We paid $450,000 per unit for all 3-bedroom apartments, then it's a very different metric, right? So price per unit is just one number to look at. I think price per square foot is another good metric to look at. And then, there's all kinds of return thresholds and things like that the people should be concerned of. So this is the number of apartment transactions by building size. And I think this is kind of an interesting story because, if you take the province of Ontario, right, at really high level numbers, we've got about 25,000 apartments in Ontario, but 80% of those 25,000 buildings are 50 units or less, right? So when we look at, apartment sizes, being built, they tend to be in that kind of mid-range size, right? Like, 50, 75, 100 and things like that. I think this is just what's been transacted, right? Which is a reflection of what's been built. But the point I want to make is that most of the deals that we see, Sally, are 150, 200 units, larger sites, 1,000-unit sites, phased-in sites, and things like that. We think that for the smaller developer out there, across Canada and in neighborhoods, there's a huge opportunity here to build smaller apartment buildings, 10, 15, 20, 30, 40 suiters. And then what's our logic for that? Well, if we went between 1950 and 1975, and most of the apartments were built in this country, 80% of them were smaller buildings. Yeah. So why is it that every building being built right now is a great big building? I think it's because the industry is just making a comeback for many reasons. And this will filter down to the mid-market, to infill sites. And by the way, when you go to smaller buildings, the buyer pool gets larger, because lots of people can afford a $5 or $10 million building. Not that many people are in a position to buy a 100-unit building. So, Sally, we're going to talk about cap rates here.
Sure.
Right?
I mean, the number one question that we always get at the end of a feasibility study, because the end of a feasibility study is, a high-level valuation of how much your building will be worth. And the key question they want to know is the rent or the cap rate. So that's going to determine your value. So this is just looking at, this comes from CBRE, obviously, but it's our analysis. Looking at how cap rates have compressed between 2016 and 2019. We don't see the compression stopping anytime soon. So you can see that over the last couple of years, Montreal cap rates have compressed, three quarters of a point. Most major markets have seen at least a half-point compression overall. I think the point that Derek wanted to make, though, is that looking at these numbers, cap rates are not as low as you think.
Yeah, and I think this is a really important point. So if you're going to remember anything, I think, from today's webinar, it is the cap rate. So first of all, who determines the cap rate? It's not the broker, it's not the developer, it's not the appraiser, it's the market,
Yes.
right? So cap rates are changing. Sometimes it takes 6 months to 9 months to get a deal done. So when a deal is done, even assuming that the industry gets the right numbers from the deal, you're looking at a cap rate that was sometimes 9 months old, right? So cap rates are certainly tied to interest rates, but I think they're also tied to the velocity of money. Here's where the disconnect occurs on cap rates. So we live in the GTA, right? We do a lot of work in this marketplace, and we have lots of older buildings that are selling at extraordinarily low cap rates, and these are 1950, 1960, 1970 buildings, rent controlled, not in particularly good shape, and all of a sudden the building transacts for let's say a 3 cap rate.
Yep.
Or even less than 3. But what happens is when you go to apartment conventions, everybody talks about the exception.
Yes.
Right? So a developer, and typically most developers aren't in the apartment industry, they're condo developers, hotel developers, and so on. So they go, well, if an old building can get a 3% cap rate, I should be able to get 2%.
Yes.
No, and the reason the old building got a 3% cap rate is because there's upside in the rent. There's old tenants living there. When they turn over, they can go to the market, or there's excess density,
Yep.
right? Where they can, build another building or tear down the building. That's why those cap rates are so low. If you build a new apartment building, do not think that you're going to get the cap rate that you're going to get for an older rundown building with lots of upside and
Excess
development
land.
and development potential. So cap rates are going to vary, but they're not as low as the older buildings in your marketplace.
The other thing that we get asked a lot is about construction costs. So obviously we're not construction cost experts, but we always keep our eye on what the trends are, so we can talk about it intelligently with our clients. This comes from the Altus Construction Cost Guide. Obviously, you can play back this and look at the figures a little bit more. But really, what we're looking at is how the construction costs have changed over the last 3 years, to show that there has indeed been a significant increase in construction costs.
Right, and that's what we hear from developers all the time. Right?
All the
Oh,
time.
Construction costs have gone up. Well, we understand that, right? But here's what else has also changed, right? Rents have changed, right? So let's think about, so you're building an apartment building today, right? What do you really control, right? So do you control the price of land? No, it is what it is.
Yeah.
Construction costs are what they are. Heat, hydro, water taxes are what they are. And cap rates aren't determined by you, they're determined by the marketplace, right? After the fact. So what can you control? The only thing that you can control is the rent.
Yep.
And here's, we should have a slide for this next time. For every $100 in rent, you increase the value of your building by $24,000. That's $100 per month. So if you can raise your rent from $2,100 to $2,200, that extra $100 all goes to your bottom line because all your costs are fixed, right? Make 100 times 12. Let's use a 5 cap rate to keep it simple, equals $24,000. Yep. So if you are able to design a building for the same cost, but because it's well designed, well managed, and well run, and you could get $200 more in rent, you're going to make almost $50,000. You're going to make $50,000 more because you've done your planning, your designing, and your management properly. So really, when we do work for our clients in our feasibility studies, it's all about the rent. Yep. Land, construction, heat, hydro, water taxes are what they are. You're going to do the best you can on this, obviously, right? But the one factor you control is rent. And rent depends, and rent is driven by 4 things. Number 1, location, and location is what it is, right? So if it's not the right location, then just, no, you can go to the next slide.
That's fine.
Yeah. So if it's not the right location, then you can't make it the right location. Sell that piece of dirt and go buy the right piece of dirt. Yep. Sometimes that's the advice that that we have to give people, right? So number 1 is location. Number 2 is the apartment design itself, yep. Right? And so an 800 square foot apartment built properly is not the same as an 800 square foot apartment designed improperly, yep. Right? No renter ever says, what's the price per square foot to us? I've 30 years I've been doing this, and at least thousands of apartments, had 1,000 leasing agents, and nobody's ever said to me, come into our office saying, what's the price per square foot? Mm-hmm. And if someone comes in and says, what's the price per square foot, you can be sure he's a developer shopping your property, because that's just how he thinks. And you say, welcome, Mr. Developer, let me show you around your property. Let me show you around our great property here, right? And so, and then the last one, the 4th one, is the property management platform. Mm-hmm. So that's the way you do the leasing. You think about places that have great service, great ambiance, people who are dressed good, great attitude, customer service, they get a higher fee. You think about the hotel example, right? We can show you in lots of examples by changing the the property management and the lease-up platform and the leasing people, the way they're hired, trained, coiffed, and compensated, right, is going to produce a significant result for you of $100 or $200 more in rent. And there's an ability, and it's almost reckless to say this, but you could double your profit. I think by getting that lease-up process and that design process right, because as cap rates drop and you apply that cap rate against an NOI that goes right to your bottom line, there's a real amplification in the value of your property. So Sally, this is what we do, guys. So our relationship with developers starts with a feasibility study. If you're interested in it, contact us. We're happy to send you lots of information before we ever talk to you, so that you can understand what we do, how we do it, and and some of the information you get. But what we try and do in our feasibility study is answer 5 questions, right? And the first question is, well, should you build? And if the answer is no, we're going to give you a quick free no. We've done 600-700 of these feasibility studies now across Canada. And if you come to us with a suburban site where you backed up all your density onto one corner and you got to build a 20-story building with 5 levels of underground parking in a B suburb, the answer is no. Don't spend your money. Don't do a feasibility study. It's not going to work. And then, so that's one time. Doesn't mean that site doesn't work. What it means is that what you're building on that site doesn't work. So there's some sites, if it's a far suburban site, then it's probably going to be something that should be frame construction, or it should be 5 stories of cold roll steel with precast hollow core slabs, right? As you move closer into the to the city and the suburbs, then you should be considering maybe a 8, 10, 12 story precast structure. As you move to downtown, transit oriented infill sites, then you want to be going to your traditional high rise project, and there's things in the middle. But I'll tell you, it's not always about jamming the most amount of density on a site, because parking can be expensive. Adding a second, third level of parking and things like that can be extraordinarily expensive. So we're going to answer the question, should you build? If it's no, we're going to tell you that right up front. And if it's yes, then we're going to dig into the details.
And I think that in this webinar as well, we've indicated that for 2020, we see rental is still a viable investment platform to consider. Yeah.
And then the next question is, what should you build, right? So if you've got 100,000 square feet of net rentable, and by the way, the language Sally and I talk is always net rentable. Like, we never talk gross, right? Because you're only renting, the part of the building that you can rent, an 85% efficient building and things like that. So what should you build? So let's say you had 100,000 square feet of buildable of net rentable, right? Let's look at some examples. 3 examples. You could build 500. You could build 200 500 square foot apartments. You could build 100,000 square foot apartments, or you could build 52,000 square foot apartments. Those are pretty extreme, right? 200 to 50. But it would depend on where your building is. So if you are at a center ice, transit oriented, employment, entertainment, young people, wealthy people, wealthy young people there, maybe you should be building 200, 500 square foot apartments, right? But if you were in a rich, heritage, barrier to entry part of the city where housing prices are, $1, $2, $3 million, then you should maybe be considering building 50 apartments at 2,000 square feet, right? It's just an example I'm trying to give you as to how you think it through. So if you build 50 apartments at 100,000 square feet, you've only got 50 kitchens.
Absolutely.
You've only got 50 front doors, and things like that. You've only got 50 development charges, right? And so you've got to what you should build is really driven by the economics and the demographics of the area and the people walk around. I mean, it's a topic that we are passionate about. And if you want to talk to us, we'll spend a lot of time in our initial screen share presentation with you talking about the people who are going to live in your building, their habits, what they want, how they behave, and things like that. Even how you name the building depends on the people coming into your building, right?
So the third question is, what's the depth of the market? And I think we've spoken to that a little bit in terms of where we see the depth of the market right now in each of the different markets across Canada. Obviously, we can go into more detail if you have a specific question for a specific market, but right now we don't see a huge depth of market.
Right. But because we get asked that question, and your lender's going to ask that question, and your joint venture partner's going to ask that question, your mezzanine lender's going to ask that question. So we spend a lot of time, almost too much in our reports, saying something, justifying something that we already know, but we understand it needs to get done. And if you're going to spend, $50 or $100 million, then you want to get this thing, kind of nailed down as to, if you build it, will they come in? And we haven't seen a case really ever in Canadian history where an apartment building hasn't filled up because the market, few exceptions for McMurray,
Yeah.
right? And rarely do you see an apartment building fail. And when we've seen an apartment building fail, it's usually because of a partnership problem or a finance problem, not related to the specific site.
Yep.
The developer's got into trouble, somewhere else and things like that, right? So question number 4 is the big one.
Yep.
That is the one that you hire and pay us to answer.
Mhm.
How much rent can you charge? And we give you so we tell you, the size of the building you can build, subject to the zoning,
Yep.
the volumetric studies, right? We tell you the unit mix, and we tell you the unit size, right? And then we're going to tell you how much rent you can charge, right? And that's the most important number that you're going to put in your pro forma. As the relationship goes on, we'll build a financial model, and you look and you see what a 10% or 5% increase in rent does to your returns versus a 5% increase in construction cost or 5% decrease in operating costs. It's all about the rent, and that's what we spend our time focusing in on.
And I'd also say a lot of the data that I've shown today up front in this presentation is from CMHC. It's extremely useful as a benchmark, but when you're trying to figure out how much rent you can charge, there's a lot more that goes into determining it. As Derek has indicated, it's about what you build and who your target renter is, and also your competition in the marketplace. So it goes beyond just the CMHC.
Well, yeah, and CMHC is an average of buildings that are on average 40 years old.
Yep.
Right? So you just can't use CMHC data. CMHC is a good bellwether benchmark indicator. So if CMHC shows rents are going up in your town, then they're probably going up across the board, but that is definitely not your rent. Even the rate of increase isn't
Exactly.
the amount that you get in brand new construction. Condos are also not a very good proxy of rental rate, rented condos, because if I own one individual condo, I don't have a web page, marketing, sales, and all that stuff, right? And I haven't bought it to make a return on yield. I just bought it to make a capital gain on it. When you build an apartment, you're looking at cash on cash return, IRR, and things like that. And they're not well managed. So your rent as a purpose-built rental will almost always be higher than an equivalent condo across the street. So it's not a good benchmark to use either. It's a combination of, there's more and more construction. We started doing these things like 20 years ago. So there were no comps, right?
Yeah.
Now there are competitors, but you're going to always be designing your building better than that guy who's down the road or across the street from you. And you're going to be looking at renovated apartments, right? It's amazing that the lift in rents on turnover developers will spend $20,000, $30,000, $40,000 per unit. They can't make the building with 9-foot ceilings and central air, but they can do a lot to bring that apartment up to speed and things like that. So how much rent you charge is a critical part of what we do. It's the largest part of our study. And then the last part is, what's my building worth? So we will take that building that we've designed for, you call that 100-unit building,
Yeah.
right? We will design the building for you at a high level, and then you give that information to the architect, and then we'll rough out your first level pro forma as to income, expenses, and apply what we think is a reasonable cap rate to it to give you a value of that building. Then you compare the construction cost to that, and now you're in a position to make a decision as to whether you want to build, whether you want to build that apartment building.
So I'd also say that earlier in the presentation, we looked at where we think cap rates have come from in 2019, where we believe they're going in 2020. Obviously, when we are doing the valuation of your building, it's not just about the CBRE cap rate report. It's also tracking transactions, which Derek spoke about through the presentation. So we run a number of new apartment construction events, and these are deep drill educational events. They're typically not panels of 5-6 people sitting on the panel. They are longer sessions, deeper drill. We've got the Excel spreadsheet, on the screen, and they're designed for developers. Yes.
Right. And so we've got a seminar series, coming up, Juliet. And so this is now our 9th one that we've run, and it's a 2-day event in Toronto, a new apartment construction development symposium, June 3rd and 4th at the Sheraton Center. I think we've got. We'll just this is actually last year's event.
Yep.
And actually, what is that? So there you see Sally in the front there. So like part of doing this is also developers like meeting developers.
Yep.
Okay. And we restrict attendance to developers only, and it's priced accordingly, right? And anyway, so we found that developers will have 100 people some years, 150 people some years from across Canada come there. It surprises me how far people come from to attend these sessions, but it's a great opportunity to get to detailed, deep drill advice on new apartment construction. As well as meet people like yourself who are either already developed or thinking of development, and to kind of just share ideas and things like that with them. We'll send all of you some information shortly on this event, but if you were thinking that this might make sense, you can kind of pencil it off. right? Yeah, and these are the
So
sections.
registration will be coming. It's not open yet, but
But it will be this week or next week.
yeah, it'll be coming this week or next week. And also, it's not just about our own events. Me and Derek travel across the country throughout the year to go to the Western Canadian Apartment Investment Conference in this series across Canada. So we'll be in Vancouver on April 1st. And so if you're going to be there, then we'd love to.
We're happy to chat with you, and we're speaking there as well.
So thank you very much for your patience today. I know we've gone through a lot, but Derek, I wanted to ask you, before we finish this, just to leave off on a light note, what's one piece of advice that you've never given before?
Well, I don't know. I know it's a light note, but you've asked me to say something that and we write and we speak all the time, so there's not that much we don't say in public, right? But if I think about it, I would say, sort of, Sally, like, well, first is like, don't take a knife to a gunfight. Right? Like, I mean, you want to be prepared, when you go into this business. And so if the one mistake that I have seen, and it's a serious mistake and a painful mistake, we've seen it now several times, where developers are very capable developers, but they're really just, they're not lease-up people, right? So they hire someone to do the lease-up who's a capable salesperson, capable company, and then they lease all the smallest apartments too quickly at too low a price, and they're left with all the other units. And then they call us up and say, things have stalled. Well, the problem was
No.
Yeah, okay. So the problem is that, you've rented out a whole row of apartments, all the O1, all the small one bedrooms at too low a price. You haven't charged by view premium, whatever it is. But you've got to look for, when you're doing your lease up, I mean, the one piece of advice I want to give you would be to have your lease up schedule look like a checkerboard. You want to rent some big apartments, some small, some high, some low, and things like that, right? Okay. So anyway, so I think that kind of brings us to the end of our the end of our session. We thank you very much for joining us, and we'll be sending everybody later on today a video, right, of this event as well as some related information. So thanks again for joining us, and happy New Year. I think 2020 is going to be a good year for people in the apartment industry.